Okay, so um, let's unpack this. We've all heard the buzz around blockchain and crypto, right?
Yeah.
There was that massive initial explosion, everyone talking about it, and then maybe things seem to quiet down a bit.
The hype definitely cooled off from that peak, say, back in the late 2010s.
But here's the interesting thing we found looking through the material. The technology itself, which has actually been around since Bitcoin, back in 2009.
A long time now.
Exactly. It hasn't gone anywhere. It's
Uh-uh.
actually been making some uh, quiet but pretty significant advances. More behind the scenes, maybe?
That's absolutely right. While, the big public spotlight might have moved on slightly, the actual work, the development, that's continued. We're seeing the tech mature, finding real uses beyond just, well, speculation.
And that's really our mission for this deep dive. We've gathered a whole stack of sources, articles, research looking specifically at blockchain and crypto trends. What's happening now, heading into 2025, and what's on the horizon.
Yeah, the idea is to cut through all that noise.
Right. Extract the important stuff, the nuggets of knowledge, and give you a really clear picture of what's actually going on. What's next?
Think of it like getting past the quick headlines. We want to understand the underlying shifts, the real progress. We'll be covering market stuff, regulations, new tech uses, even the environmental questions.
It's all about those tangible trends,
Yeah.
the things proving the tech's value now.
Exactly. So where should we start?
Well, I think the first and maybe the most crucial point that comes through with the sources is that blockchain fundamentally has proven itself. It's not just theory anymore.
Totally agree. After, 15 years now, the tech has shown it works, especially as a system for storing value securely. And a key part of that is immutability.
Meaning it can't be changed once it's recorded.
Precisely. The core idea is that the record, the ledger, cannot be edited or altered after the fact. And, as far as we know, the fundamental ledger technology hasn't been compromised in a way that changes that history. It's proven itself as a secure, tamper-free system using cryptography.
That proven foundation is so important. And then building on that secure base, we've seen some serious market momentum recently, haven't we? The crypto market seems to be really surging back.
It really has. Market cap is back up there, close to its old record highs. Now, Q1 of 2025, it saw some choppiness. Factors like U.S. trade tariffs were mentioned,
Right.
but the sources suggest it showed resilience and signs of stabilization were appearing as we moved into Q2.
Okay, so resilience is key. But what are the big things driving this current bull market? What did the material point to?
The sources really highlighted two main factors. First, the approval of those spot Bitcoin ETFs by the SEC. That was January 2024.
Yeah, that felt like a big moment.
It was a game changer because suddenly it opened up Bitcoin exposure to a much, much wider group of investors.
You mean people that invest through their normal channels, like through wealth advisors or in their 401ks or IRAs, without needing to, actually buy Bitcoin themselves or use a crypto exchange?
Exactly that. It just lowers the barrier to entry hugely for institutions, for regular retail investors, everyone.
Hmm.
And we're seeing the effects already.
Like,
Well, the sources mentioned BlackRock and Fidelity becoming major players almost immediately. They hold substantial Bitcoin now through these ETFs. We saw figures like $15 billion for BlackRock and
wow.
$9 billion for Fidelity. It's serious capital flowing in.
That's a huge amount of traditional money entering the space.
Okay.
Okay, so ETFs are number one. What's the second driver?
The second big one is the Bitcoin halving event. The latest one was just in April 2024.
Right. That happens periodically.
Roughly every 4 years, yeah. And what it does is it cuts the reward for mining new Bitcoin blocks in half. So fundamentally, it decreases the rate at which new Bitcoin supply enters the market.
Less new Bitcoin being created. So basic economics suggests.
Exactly. If the growth of supply slows down and demand stays the same or hopefully increases, then the price tends to go up. Analysts are predicting this halving will boost demand relative to that constrained supply.
And does history back that up?
The material pointed out that, previous halvings, like in 2016 and 2020, they were followed by pretty significant gains for Bitcoin, something like 51% and 83% respectively in the 6 months after.
51 and 83%. That's substantial. And experts are expecting something similar this time around.
Many are, yes. The sources mention nearly half the experts surveyed think Bitcoin will hit a new all-time high within 6 months of that April 2024 halving. So you put those two things together, easier access through ETFs, plus the supply shock from the halving, and those are your key market drivers right now.
That makes a lot of sense. Okay, so as the market grows like this, gets more mature, it naturally attracts more attention from well, regulators. This seems like a huge focus area now, especially after things like, the FTX collapse.
Oh, absolutely. Governments, regulatory bodies everywhere, they're really working hard to get frameworks in place. In the U.S., the SEC has been particularly active.
Right.
Their stance, as reported in the research, is basically that most crypto assets are securities, which means firms need to register, they need to follow disclosure rules, all that.
And they haven't just been talking, they've been acting on that.
They certainly have. We saw mentions of the SEC suing big names like Coinbase and Binance back in June 2023. And that Binance case, that led to massive fines, right? Like $4 billion later that year.
$4 billion.
Yeah. And the sources said across 2023, the SEC actually sued 5 different crypto companies in total.
Now, what's interesting, and sources touched on this, is how U.S. politics might be influencing this whole regulatory picture.
Yes, that was mentioned. The incoming U.S. president, Donald Trump, has apparently indicated a potentially, let's say, friendlier approach to the crypto industry. There's talk his administration might roll back some of the regulations from the previous one.
So the industry might be expecting clearer, maybe more favorable rules soon in the U.S.
That seems to be the expectation, yeah. Creating a bit of uncertainty, but also maybe hope for some clarity.
But it's not just a U.S. thing, right? This regulatory push is global.
Definitely global. We're seeing similar developments everywhere. The EU, for instance, has its markets in crypto assets regulation, MiCA, that fully took effect in December 2024.
And why is MiCA significant?
Because it creates a single, uniform set of rules across the entire European Union. That brings a lot of stability and clarity for companies operating there.
Does all this regulatory activity, especially the uncertainty maybe in the U.S., actually affect where these crypto companies decide to set up shop?
It looks like it does. The research mentioned companies like Gemini looking at the UAE and Coinbase setting up in Bermuda, and they specifically cited regulatory concerns or the lack of clarity as a reason.
So jurisdictions are almost competing now based on their crypto rules.
It seems that way, yeah. Regulatory frameworks are becoming a competitive advantage.
Okay, let's shift gears a bit. A challenge that always comes up with crypto, particularly Bitcoin, is the environment, the energy use. That's still a big issue, isn't it? Yeah.
It absolutely is. The significant energy consumption and also water usage, it's mostly tied to that proof-of-work mining process.
Which Bitcoin uses.
Which Bitcoin uses, yes. It requires just immense computing power to validate transactions and keep the network secure, and that means huge amounts of electricity.
And the numbers we saw in the sources were, frankly, quite staggering.
They really are. Things like Bitcoin using more electricity per year than the entire Netherlands.
More than a whole country.
Yeah, and a single Bitcoin transaction. It can use the same energy as an average U.S. household does over, what was it, nearly 26 days?
26 days for one transaction. And a lot of that energy isn't clean, right?
That's the other part. Around 67% of it still comes from fossil fuels, according to the data cited, which has led UN scientists to warn about, potential impacts on climate goals. And then there's the water footprint, too.
Water?
Yeah. Bitcoin mining globally uses a massive amount of water annually, estimated up to maybe 2,237 gigaliters. It's substantial.
It's a serious environmental cost. But, and this is important, the material also highlighted that not all blockchain tech has this problem, correct?
That is crucial. Ethereum is the big example here. They switched from proof of work to proof of stake, or POS, back in September 2022. Remember the merge?
Right, the merge. And what did that do?
It fundamentally changed how Ethereum secures its network, and it slashed its energy consumption by over 99%.
99%. So it showed sustainability is possible for a major blockchain.
Exactly. It proved it can be done at scale. However, the sources also indicate that Bitcoin is, well, very unlikely to make a similar switch.
Why is that?
Mostly due to its core design philosophy, its decentralized governance. It's just not built in a way that makes a fundamental shift like that easy or likely. So while solutions like POS exist and other networks are using them, Bitcoin's environmental footprint remains a challenge.
A persistent challenge. Okay, so while that's ongoing, the tech is also enabling some really exciting new applications beyond just currency. One area that seems to be booming is tokenizing real-world assets.
Yes, tokenization. This is basically using blockchain to create digital tokens that represent ownership or maybe rights to physical things.
Like what sort of things?
All sorts. The sources mention real estate, fine art, company bonds, intellectual property, even to like individual racehorses or specific container ships.
Wow, okay. And what are the benefits of doing that? Why tokenize a racehorse?
Well, the benefits highlighted are things like fractional ownership. So you could own, say, just 1% of that expensive racehorse or a piece of art.
Makes high-value assets more accessible.
Exactly. It can also allow for automation using smart contracts, provides really clear, traceable ownership history on the blockchain, and potentially makes these assets more liquid, easier to buy and sell quickly than they were before.
And it's not just a theoretical idea, right? Financial institutions are getting involved.
That's a big sign it's maturing, yes. BlackRock was mentioned again. They launched a fund called BUIDL in 2024.
BIDL.
Yeah, it tokenizes assets on the Ethereum blockchain. They partnered with a firm called Securitize, and it got traction fast, brought in $240 million in its first week.
$240 million in a week for tokenized assets.
Yeah, and Citigroup is also in this space, testing asset tokenization on a private blockchain. Their goal is enabling instant 247 transfers and cutting processing times way down.
So it's moving from concept to actual deployment by the big players. What do the market forecasts look like for this trend?
They're pretty bullish. Some estimates we saw have the market growing from maybe $2.8 billion in 2023 to potentially $9.8 billion by 2030.
Okay, significant growth.
But others are even more optimistic. Boston Consulting Group, for example, suggested it could reach, get this, up to $16 trillion by 2030.
16 trillion. With a T.
That's what they projected, yeah, potentially representing something like 10% of global GDP.
That's transformative if it happens. A fundamental change in asset management. What's the catch? What are the challenges mentioned?
A key one they highlighted is how do you make sure that digital token stays reliably connected to the actual real-world asset? And how do you verify that the physical thing, the building, the artwork, whatever, actually exists and is, being looked after properly?
Right, that link between the digital and the physical has to be solid.
Absolutely critical for trust.
Okay. So moving from decentralized assets, let's look at something more centralized that's getting a lot of global attention. Central bank digital currencies, CBDCs.
Right, and these are quite different from things like Bitcoin or Ether. CBDCs are digital versions of a country's official currency, like a digital dollar or digital euro issued and controlled by the central bank.
So not decentralized at all.
Not at all. They aim to give some benefits of digital money, like efficiency and speed, but within that existing government-controlled financial system.
And is this just an idea, or are countries actually doing this?
Oh, it's way beyond just an idea. The research indicates 132 countries are actively involved.
132.
Yes, representing something like 98% of the world's GDP. They're all either exploring, developing, or actually piloting CBDCs right now.
Are any actually live yet? Can people use them?
Yes. Countries like Jamaica, Nigeria, the Bahamas, they already have operational retail CBDCs. And China's trial of their digital yuan, the ECNY, is massive, involves millions of people.
What's the outlook? How many might we see soon?
The Bank for International Settlements, the BIS, they predict we could see maybe 15 retail and 9 wholesale CBDCs operational around the world by 2030.
And how would these different digital currencies work together across borders?
That's where SWIFT is stepping in, the global banking messaging network. They're planning to launch a specific network designed to connect these different national CBDC platforms, make international payments easier. They've already tested it with 38 banks, apparently.
Okay, so the infrastructure for cross-border CBDCs is being built. Now, what really stood out in the sources was the U.S. position on this. It seems quite different.
It really does. U.S. officials, according to the material, currently have no plans to actually develop a U.S. CBDC. They've stated that doing so would need specific authorization from Congress.
And why the hesitation? What reasons were given?
The main concerns noted were, firstly, U.S. consumer privacy, worries about a centralized digital currency potentially allowing the government to track spending too easily.
Okay, privacy concerns. What else?
And also pushback from the existing banking sector. Worries about the potential negative impact on commercial banks, on credit availability, and just the overall stability of the financial system if the central bank offered digital accounts directly.
So while most of the world is charging ahead with CBDCs, the U.S. is being much more cautious, citing privacy and financial stability concerns. Interesting contrast.
Very much so.
Okay, beyond these really big shifts like tokenization and CBDCs, what else is happening on the innovation front within blockchain? Is
Yeah.
development still active?
Oh yeah, definitely. There's a lot of focus on improving the actual user experience, making crypto easier to use. One example is Wallet as a Service, or WAS.
Wallet as a service. What's that?
Basically, it provides ready-made digital wallet infrastructure that companies can just plug into their apps.
Ah, so users don't have to deal with all the complicated setup.
Exactly. It handles the tricky stuff like managing private keys, security, connecting to the blockchain infrastructure, all that happens in the background, makes it much simpler for both the app developers and the end users.
Makes sense.
Right.
What about getting different blockchains to kind of talk to each other?
Yes, interoperability. That's a huge theme. Finding ways to easily move assets or data between different blockchain networks. Plus, there's ongoing work just creating better tools for developers to build blockchain applications in the first place.
Did the sources mention any specific companies pushing this kind of infrastructure forward?
Yeah, a few names came up. JP Morgan has something called Connexes using blockchain and tokenization for things like cross-border payments. There's the Canton Network, which aims to link up institutional financial markets using distributed ledgers. Quorum was mentioned, that's like an enterprise version of Ethereum. And a company called D-Block, trying to merge crypto wallets smoothly with traditional bank accounts.
Right, integrating it more seamlessly. Now, here's a concept that sounds really futuristic, but is apparently happening now. Decentralized physical infrastructure networks. DePIN.
DePIN, yeah. It's a fascinating idea. It uses blockchain to coordinate and manage actual physical hardware, like computers, data storage, or wireless hotspots that are spread out geographically.
So instead of one company owning all the servers, individuals share theirs.
Pretty much. It lets people rent out their unused resources like computing power or storage space and get paid for it directly using crypto tokens, all managed decentrally on a blockchain without a central middleman company.
Can you give us a concrete example, what was mentioned?
The main example given was pooling together lots of individual consumer PCs that have powerful graphics cards, GPUs.
Right, like gaming PCs.
Exactly. Pooling that power to handle really intensive computing tasks like the kind needed to train or run big AI models like ChatGPT. DePIN uses the blockchain to track who contributed how much power and make sure they get paid fairly for it.
That's a really tangible use case, distributed computing power managed via blockchain. Another critical area, especially now with AI generating so much content and deepfakes being a concern, is proving where data came from. Data provenance.
Absolutely vital. Knowing the origin of data, who created it, and critically that it hasn't been messed with, that's becoming incredibly important. And blockchain's immutability is perfect for this.
How so?
Because you can create a permanent, tamper-proof record on the blockchain. The sources mention Verizon's full transparency initiative, using blockchain to authenticate their corporate communications so people know it's genuinely from them.
Okay.
And also vendors like Square, which can integrate directly with cameras to create an immutable blockchain record the instant a photo or video is taken, verifying its authenticity from the source.
That seems incredibly relevant now. And it brings us back to that intersection of AI and crypto you mentioned earlier.
Yeah, it's a definite trend. We're seeing the rise of what are called AI tokens.
AI tokens.
These are basically cryptocurrencies that are specifically linked to AI-focused projects. Things like blockchain protocols designed for AI or platforms for decentralized machine learning, that sort of thing.
And how are these tokens doing?
Their value has just exploded, according to the figures cited. The total market cap went from around $2.7 billion to over $39 billion quite recently.
Wow, that's exponential growth.
Yeah.
Any specific examples stand out?
Fetch.ai was highlighted. Its token saw a huge value increase. And interestingly, Fetch.ai is now merging with two other projects, SingularityNet and Ocean Protocol.
Merging.
Yeah, they're forming a new combined token called ASI under an umbrella they're calling the Superintelligence Alliance.
Superintelligence Alliance. Sounds ambitious.
It does. Their stated goal is to push forward decentralized AI development, positioning it as an alternative to the AI being developed by the huge, dominant tech companies.
Interesting. Using blockchain to try and decentralize AI power. Okay, shifting gears one last time, let's quickly touch on the business side. How's the investment climate and industry health looking?
Well, as we discussed with the market surge, investor confidence definitely seems to be returning, especially for those startups that are focusing on real-world applications and the underlying infrastructure. VC funding saw a recent peak, mentioned as $485 million in February 2024.
So venture capital is flowing back in. What about the public companies like those miners we talked about?
They've done very well recently, stock-wise. Bitcoin mining firms saw huge gains mentioned in the sources. Marathon Digital up 590%, CleanSpark 440%, Riot Platforms 350% over the period cited.
But does the halving, the event that cuts their revenue per block, impact them negatively?
It certainly puts pressure on efficiency, yes. The less efficient mining operations struggle more when the reward drops, and this is driving consolidation.
Meaning the big fish eat the small fish.
Essentially, yeah. We're seeing the larger, more efficient mining companies acquiring smaller ones that might not be profitable post-halving. The sources gave examples like CleanSpark making acquisitions and that big merger between Hut 8 and US Bitcoin Corp.
So the industry is consolidating around the bigger, more efficient players. Okay. Finally, looking way out into the future, the sources flagged one really significant technical challenge on the horizon.
Ah, yes, the quantum computing threat.
Quantum computing. Explain that.
Well, the security of current blockchain technology relies heavily on specific types of encryption, public key cryptography, mainly.
Right.
The problem is, future quantum computers, once they become powerful enough, are expected to be able to break these current encryption methods relatively easily.
Break the encryption. That sounds bad for blockchain.
It is a serious long-term threat, yes. It means that eventually blockchain networks will need to upgrade their fundamental cryptographic algorithms to ones that are resistant to quantum attacks, so-called post-quantum cryptography.
Can they...
That's the challenge highlighted. Especially for highly decentralized networks like Bitcoin, there's no central authority to just decide, okay, everyone, we're switching algorithms now. Getting network-wide consensus for such a fundamental change could be very difficult and complex. It's a major technical hurdle they'll need to overcome down the line.
A really significant future challenge to keep an eye on.
Yeah.
Wow. Okay, so if we just step back and look at everything we've unpacked from these sources, we started by saying, yeah, the initial massive hype may be faded, but what seems really clear now is that blockchain tech has seriously matured.
Definitely.
It's finding real, tangible applications across so many different areas. Managing value, tokenizing assets, making payments faster, even trying to tackle its own environmental issues with things like proof of stake, and interacting with AI and physical stuff through DePIN.
Absolutely. The progress, the diversification of uses, it's undeniable. But as we've also covered, the space is still grappling with some pretty big challenges, right?
Oh, sure.
Getting clear, consistent regulation globally is huge. Mitigating that environmental impact, especially for proof-of-work chains. And then looking ahead, preparing for future technical threats like quantum computing. Efforts are happening on all those fronts, but they are definitely ongoing hurdles.
It really paints a picture of a technology that's moving past just the initial promise and getting into the messy, complicated, but also potentially powerful reality. So given this huge range of applications we talked about, finance, assets, data, infrastructure, and this constant evolution, here's maybe a final thought for you, the listener, to ponder. How might these steady, ongoing advances in blockchain, even with all the challenges, actually start to fundamentally reshape how you interact with things like assets, your data, how you make payments, even the physical systems around you in the next few years? Think about the services and infrastructure you rely on every day. Could blockchain be quietly changing them already or be about to? Something to think about.